Morning, Gurpreet.
Hi there.
How are you doing?
Yes, very well, thanks.
Good, good. Thank you for joining us today. Excited to hear about the market and what you've got to say. So,
Great. No, thank you for the invite.
yeah, no, all good. So, shall we do what we usually do? Give you sort of 10 minutes just to run through what the fund does, and then
Yeah.
we'll get questions.
Yeah, great stuff. Thank you all, and hi everyone listening in. My name's Gurpreet Gujral. I'm a managing director at Atrato Partners. I have been in the renewables industry for over 15 years. Previously, a director at Macquarie, where I was working within the investment team at the Green Investment Group, and joined joined Atrato about 3 years ago. To help set up the renewable energy franchise. I'll first take you through a short presentation on the UK solar market, specifically focusing on commercial and industrial solar, which is I guess a new subsector within the renewable energy industry, and then open up to Q&A after that, if that's okay. Firstly, Atrato Onsite Energy is a client of Atrato Partners and is the leading UK commercial and industrial solar listed fund. The company has invested or committed 198 million pounds into solar PV systems across 41 different assets in the UK. And its solar projects supply electricity to customers like Nissan, Tesco's, Amazon, Marks and Spencer's, and is thus supporting the UK net zero transition. Just moving on to the next slide. Maybe firstly starting off with a few macro points. Look, there's three key drivers of the expected increase in demand for clean electricity, as well as just electricity in general. The first is corporate and national targets to reach net zero. Organizations, as I'm sure you all have seen, are increasingly setting themselves targets to decarbonize, and this is naturally increasing the demand for those corporates to procure clean energy directly. The second, and this is one of the great investment themes that's taking place today, is the electrification of transportation and heat. So we've all witnessed, I'm sure, the significant uptake in electric vehicles over the last 10 years, and that momentum is likely to continue. Moreover, the industry also expects a similar transition for heating appliances to move away from central boiler systems to heat pumps that are effectively powered by electricity. And the third driver of clean electricity is the energy security and affordability that it brings. Solar and wind assets can be generated locally, as I'm sure you all know, making the UK and other nations less reliant on the global markets of fossil fuels, and particularly the price of gas, which dictate the price of electricity in many countries, including the UK. And the improvement in the efficiencies of technologies like solar and wind now make them more economic than it ever has been, and in most cases are much more economic than traditional ways of generating electricity. Okay. Now, what does this mean in terms of money and investment required? Well, these drivers that I just mentioned underpin a significant increase in the investment required. 23 billion pounds worth of investment is required to fund new solar assets in the UK to meet the targets set by the UK government. Currently, the UK solar capacity is 16 gigawatts. That's one of the lowest actually in Europe. And in order for the UK to meet its legally binding targets, net zero targets, that number needs to get to 54 gigawatts, which is the equivalent of 23 billion pounds worth of investment over the next 10 years. And with that, the presence of government subsidies, which is now started to roll off, commercial and industrial solar will be, we think, the main driver of this growth. So moving on to the next slide. So how is this contracted? And the way in which it's contracted is through what's called a power purchase agreement. So corporates can buy energy now directly from solar or wind assets through this contract, power purchase agreement, or PPA. This is where a generator, an asset that generates electricity, enters into a direct contract with a corporate to supply that energy. Now, traditionally, a generator would sell energy that it produces to a utility company, who would then sell that energy to customers like you and I, or indeed corporate customers. And that's because traditionally energy generators were very large, centralized, typically gas-fired power stations that generate a significant amount of energy, and not one customer would ever be able to buy all of that energy in general terms. So you'd effectively need a middleman. You'll need a utility company to split that energy up and sell that to different folk. However, wind farms and solar farms are much smaller, decentralized, which makes it easier to find a dedicated buyer for the production of electricity. So in other words, a renewable energy PPA cuts out the middleman, as the electricity generator that is generated is supplied to customers directly, big corporates directly. And I will walk you through that in a bit more detail in just a few moments. Moving on to the next slide. We've seen a significant increase in the amount of corporate PPAs in the last few years, and that's really a function of the price of solar and wind coming down over the last few years, given the improvements in the efficiency and the technology, and that's led many corporates to take on more PPAs. And here you can see a 360% increase in demand or uptake, I should say, in solar PPAs over the last 5 or 6 years. And we expect this to continue, and it's very much a new asset class, but as most things, originated in America, and is very popular in the States, and has started to filter into Europe over the last few years. And we're starting to see that certainly in the last couple of years here in the UK. Okay, and our business is very much part of that trend. So let's just perhaps take a step back and think about how corporates decide to buy energy. Okay, traditionally they would buy energy by going to their utility company, and if they wanted to buy clean energy, they would ask their utility company to put them on a green tariff. Now that tariff is typically priced at about 25 pence a unit today. In the last year we've seen that price come down quite significantly. I'm sure you've seen in the news the price of electricity has significantly increased since the start of the war in Russia and Ukraine. But crucially, a big part of that 25 pence is actually what's called the non-commodity cost, and that is the cost to deliver that energy from that large centralized power station to your home or to your business. So of that 25p, around 15 pence is actually just to pay for the grid and all of the other ancillary charges outside of just the pure cost to generate electricity. The cheapest form of buying electricity, and this is very much what Atrato Onsite Energy is involved in, is on-site solar. So in this instance, we've called it on-site rooftop, but actually you can have a solar PV system that's located right next door to your factory or your office or your hotel. That could be on the ground, but just connected directly into your building. And indeed, if it's on your rooftop, it just goes directly into your building through what's called a private wire. So we're not using So that's not using the grid, and that energy is sold roughly at about 9 or 10 pence a kilowatt hour. So it's a significant saving because of the fact that you're effectively cutting out the middleman. Another way of supplying energy is through what's called a sleeved PPA. And this is where you may have a solar farm located on the other side of the country, but you notionally sleeve that energy using the grid to that corporate. So you're still buying energy from a solar farm or a wind farm, but you're using the grid to deliver that energy to you, and that's why it's a bit more expensive. A bit more expensive than on-site solar, but indeed still cheaper than the traditional way of buying energy through a utility company. Okay, and the focus in our conversation today is the top two circles, and that's very much what Atrato Onsite Energy is focused on. So just moving on to the next slide, if that's okay. So onsite PPAs we talked about earlier. You can see a good example of a rooftop solar PV system that's sitting on top of a factory, and that energy is sent directly downstairs to that factory at around 9 pence or 10 pence a kilowatt hour, saving that factory quite a substantial amount of costs. The factory will continue to draw energy from the grid during nighttime hours, or when you might have a cloudy situation. So you're not taking anyone off grid in any ways. You're simply supplementing that business with very clean energy, and typically most cases the rooftop system allows you to supply about 30% of the needs of that building in any given year. Okay. The other method that we talked about earlier is sleeved PPAs. This is where you might have a solar farm, a traditional solar farm that's connected to the grid, but that energy is then sleeved to that corporate. That's where you can get scale. That's where you can get real scale. It's not, you can supply a lot more energy, obviously, because you're not just constrained by the rooftop space. And then that business can then get more than 30% in many cases, nearly all of their energy from that solar farm. And what both situations mean is the customer is able to get long-term price certainty in procuring electricity. So you're not reliant on the price of gas and that volatility in the price of gas, which is obviously in many cases very much independent of your business, but can be quite risky. And then you also have a fully managed solution. And in the case of Atrato Onsite Energy, you're providing this energy through a PPA, and crucially, it means that the business doesn't have to put anything upfront in terms of costs. So all of the costs associated to the assets, the management of those assets, the maintenance of those assets is all borne by Atrato Onsite Energy. And the quid pro quo is that the customer commits to a very long-term 20-year or 25-year PPA with Atrato Onsite Energy that underpins the original investment. Moving on to the next slide, you can see here that Atrato Onsite Energy has arranged PPAs with counterparties like Amazon, Marks and Spencer's, Nissan, and Tesco, some of the biggest companies in the UK. And you can see the sort of broad nature of these assets, right across the country. And as I said earlier, the efficiency improvements that we've seen in the last 10 years in the technology in solar means that in the UK, right across, even all the way up from in Scotland, it is much more economic to procure energy via a solar panel than it is through traditional means. On to the next slide. Summarizing some of the benefits to corporates, I thought it was useful to go into detail here. I talked about the economic savings quite a lot through this presentation, but that is clearly one of the main reasons why corporates sign up to long-term PPAs. It's the fact that they don't have to invest any capital. And in most cases, most corporates aren't too interested in investing in energy generation systems. They're interested in their own business. And so for someone else to come in and fund that, that makes a lot of sense. And then they're quite happy to then commit to buying that energy from that system, even if that system's on your own rooftop, buying that energy for the next 20 years at that fixed price. That benefits the corporate because they know exactly how much they're going to be paying for electricity for the next 20 years, and obviously at that cheaper rate. But then it also benefits Atrato Onsite Energy because it has this really long-term, long income cash flow that's incredibly predictable. From an operational perspective, there's a huge amount of benefits. I talked about that fixed pricing earlier, but that's a real issue for most corporates, and they've really experienced that in the last 2 years since the war, where you've had quite significant volatility in energy prices, and that just comes out of the bottom line. That just comes out of your profits if electricity prices go up, and that's a big risk for corporates, and it's very difficult to hedge that risk through traditional means, and this is just one way of doing it. And then, of course, there's the ESG benefits. Having that green kudos of buying clean energy that's being generated on your rooftop and that's fully traceable goes a long way, and that resonates with all stakeholders of businesses, regardless of if you're a consumer-facing brand or a B2B business. That is now an important kind of work stream and project that many businesses are focused on, and this ticks clearly. It ticks a huge green kudos box for many corporates. And then finally, maybe we can just summarize. We've observed a substantial increase in the demand for electricity in the UK in recent years, but particularly clean electricity for the reasons that I talked about at the top of the presentation. Corporates are facing clean energy requirements and are looking to decarbonize. The solution here through on-site or sleeved PPAs clearly tick a number of not only clean or net zero boxes, but also very clearly economic boxes for many corporates. Atrato advises the UK's leading, we call it C&I solar, commercial and industrial solar fund. That's Atrato Onsite Energy, which from a standing start 2 years ago is now built up a portfolio of, as I said earlier, 198 million pounds worth of assets. And then finally, as mentioned earlier a couple of times, corporates receive numerous economic and operational benefits for entering into these types of PPA solutions, making it in many cases a really compelling case for those businesses. I'll stop there if that's okay, and perhaps take some questions.
Great, that's really interesting. Cool. Thanks. Yeah, questions have been coming through thick and fast, so we'll just crack straight into them, I think.
Yeah.
So cash flows of the company, how have they changed over the last few years in light of the power prices and demand for renewable energy?
So Atrato Onsite Energy, we launched 2 years ago, and as we've been going through that sort of ramp up stage, or Atrato Onsite Energy has been going through this ramp up stage of deploying capital. The results in January you may have seen show our sort of cash flow or the fund's cash flow profile, where the dividend cover for the fund is now at 1.4 times, even post the increase of the dividend in January of 10%. So there is strong cash flows that's underpinned by these long-term contracts that have been put in place over the last 2 years. So I think it's fair to say that we've grown the asset base significantly in that period, and now that the fund sits on that strong coverage, and is very much underpinned by these long-term contracts that I mentioned earlier.
Yeah, yeah, no, that's it's interesting. So you talked about how you sort of growing there. Can you talk a bit more about the fund's pipeline and how you might look to sort of fund this?
Yeah, absolutely. The pipeline is grown substantially since we launched. The the overall pipeline now sits at about 400 million pounds. I think it's fair to say that the asset class is relatively new, and it felt like certainly over the last 2 years, every time a PPA was signed and announced, the pipeline grew on the back of that. It was actually quite pleasing in many ways to have grown the pipeline without really spending that much time marketing. And so I think deals kind of almost breed deals in many ways, and so that's been really encouraging. We deployed the fund deployed 50 million pounds in the first year, 150 million pounds in the second year, and there's absolutely no reason why that can't continue. The fund has recently opened a new RCF with NatWest that has given it the capacity to continue deploying, and the fund will be using that capacity to continue to deploy into the pipeline. The pipeline is very representative of the portfolio that we have today in terms of the types of customers. A lot of repeat customers. So Atrato has the Onsite Energy Fund has a framework deal with Tesco's, for example. There's 19 stores already in the pipeline, but there is a framework exclusivity agreement in place with Tesco's to do a further 69 stores. The fund recently did a deal with Nissan up in Sunderland, where a 20 megawatt system was installed and is now operational. That was a 10 million pound investment or an 11 million pound investment. And of course now, we're now talking to Nissan about future projects across their estate in the country. So there is a number of repeat business and the repeat customers, as well as new customers, and suppliers of our existing customers getting really interested in the offering.
Yeah, no, that's really interesting. I mean, you touched on a few points there where we can go to questions here. Let's start with so with the Tesco type, there's a question here about your relationship with the sister fund, Supermarket Income REIT. Did that come about through their relationship? Do you leverage their relationship with their supermarket tenants to provide solar on their buildings?
Really good question. There certainly is a synergy there. The Supermarket Income REIT clearly has really good relationships with the grocery sector here in the UK, being the one of the largest landlords in the space. So that obviously helps. The renewable energy team also has relationships directly from our previous roles at Macquarie, for example. So yes, absolutely. The platform, the Atrato platform, I guess provides that kind of access to these corporates, and it's of course helpful being a known entity amongst these businesses. These are incredibly large businesses, and it certainly is helpful having that kind of name badge, because it just credentializes you when you walk into to meet the C-suite of a very large grocery business. They know who you are, and it certainly makes it certainly helps with the relationship. Absolutely.
Yeah, cool. And then I think you talked about their sorry, let's find the question again. So I think you talked before about recycling capital out of operational assets and into installation. Can you talk about the advantages of that and the benefits of installation over the operational?
Yeah, absolutely. It's a really good question. You know, the fund has done both since launch, as in buy operational assets as well as develop and install new assets. The installation of new assets typically generates a value uplift in terms of the portfolio, because you're originating a new deal, by securing a new commitment to buy energy through the PPAs that I mentioned for 20 years, and then going through the process of installing panels on a roof, and then commissioning that site. The value of that site on day one of operations, because of the contract that you have for the offtake, and because you've gone through that whole process of installing it, is clearly going to be higher than the value of the kit itself. Okay, and the fund experienced that in the last set of results. The fund saw a 20% increase in the value of those assets that were installed during the financial year. And so there's clearly a benefit to shareholders, not just from an income perspective, but from a value enhancement perspective on any new project that's originated and installed. And then on the operational side of things, clearly when there is a project that is already operational, spinning out cash flows immediately, that's priced attractively, that fits into the portfolio and provides synergies, then the fund will look at that as well. There's no reason why the fund shouldn't look at that, particularly at the beginning, right? Particularly at the beginning when you're trying to limit cash drag. And so I think the focus in the pipeline will certainly be on new assets. I think the vast majority of the pipeline is weighted towards new installation assets, which will ultimately deliver value uplifts. But nevertheless, if there are operational assets that's reasonably priced, that's shareholder accretive, then clearly one should look at those as well.
Yeah, cool. Question here about I think this came from the annual results. You were talking about maybe going down the route of getting a strategic investor on board. How would this work in practice, and is there any update on this?
I think what we talked about during the results was about being opportunistic and being open to growing the fund, to allow for further deployment into the pipeline. Okay, and that could be in many different forms. And I think at the time we talked about potentially a JV structure, where we might be able to bring in an investor outside of the listed world, to help support the growth of and the continued deployment of the fund. And one of Atrato's other fund, the Supermarket Income REIT, I don't know if you remember, did a similar deal with a private pension fund on a portfolio of Sainsbury's assets. So that style of arrangement is certainly on the table, and something that we're thinking about and talking to folk about. And then, of course, we also talked about recycling some of our assets, some of the assets in the fund to realize the NAV, as well as allow for an ability to deploy into the pipeline again. And I think both options are on the table. We're commercial. We're a commercial team, and the key thing here is trying to create shareholder value, but also to grow the fund, because there is clearly a strong pipeline and clearly a very strong demand for this solution that we're offering corporates. And given the capital markets and the way they are right now for investment trusts, we have to be flexible and creative about raising new capital.
Yeah, no, absolutely. So you mentioned earlier about the credit facility with NatWest.
Yep.
Can you talk a bit more about that and about your sort of debt profile in general?
Yes, sure. So our gearing ratio is currently at 33%. Part of that is an RCF that was initiated in the summer with NatWest. That was a £30 million RCF with an accordion that could take it to £50 million. So effectively an extension of another £20 million. We're really pleased about that RCF. It's priced incredibly competitively at 1.3% over SONIA, which I think if you compare that to our peers in the market, is priced really well. And that is a function of the fund's contracted nature of cash flows. And so I think the equity community can take a lot of comfort in the way in which the debt community is valuing and pricing the cash flows of the fund. So that was really encouraging. We also have some project finance with Legal and General on one of the assets, which is worth about 45 million pounds. That's priced at 2% all in, and fixed for the next 11 years. So again, another incredibly well-priced piece of debt. Most of our debt, I think about 73% of the fund's debt is fixed, and we have a bit more capacity. As I said earlier, our cap in terms of gearing is 40% as per the prospectus. So there is a bit of capacity there to deploy into our pipeline.
Yeah, no, that's good. Cool. Couple of questions here on solar, and well, one here is so obviously solar is only a partial solution because it is intermittent. Do you have any plans to go into other sort of green technologies or anything like that?
Yeah. So yes, it is a partial solution in the sense that solar will generate clearly when there is light. Okay, so it's not just about direct sunshine, but it's about illumination. It's about light, and obviously there's parts of the day where you don't have light. So it's not ever going to be the only solution. As I said earlier, the fund strategy is not to take customers off grid. They continue to be connected to the grid and continue to get supplied from the grid in those times that the panels can't supply. So yes, it's a partial solution, but it's still an effective solution in that the energy that is supplied is clearly clean, one, and two, competitively priced. Nevertheless, we have evaluated other technologies, particularly batteries and the ability to store energy. For us, the maths doesn't quite work for battery, for making that investment into batteries. The energy that's generated by solar is typically consumed instantaneously by that factory or by that warehouse, and so there isn't much excess energy to store in a battery in this type of solution, and so the requirement or the use of quite an expensive piece of kit, an installation of a battery would nearly double the capex, not quite double, but nearly double the capex of a rooftop solar PV system. And so, you know, it just doesn't make economic sense for the fund to do that, you know, because the usage won't be there. One day it might, and we're continuously evaluating that and continuously doing the maths. But as prices stand today, it doesn't make sense. Batteries today are typically commercialized in a very different way. Batteries today are typically commercialized through trading. And that is a much more volatile, much more merchant business model, in that every day when in periods of the day you have cheap electricity coming through the grid, you charge up your battery, and then you sell that electricity when the price of electricity is expensive. You can't contract that type of arbitrage. That's just an arbitrage that takes place. And you're obviously relying on those cheap times and those peak times or expensive times. That's not the business model of Atrato Onsite Energy. Atrato Onsite Energy is about long-term offtake arrangements where you have visibility over revenues for the next 10, 11 years, that give surety over dividends, and can provide that stable yield, as opposed to, you know, daily trading of intraday energy prices.
That makes sense. Would you look outside of the UK?
So the Atrato Onsite Energy's mandate is primarily UK and Ireland. So would certainly look at Ireland. There are a couple of projects in our pipeline in the Republic of Ireland, and so that's definitely a place that we'll have activity on. And of course, a lot of the customers in the fund already have a footprint in Ireland, and so that's just a natural step. There is the capability to go into, I think a portion of the fund, capped at 20%, can go into OECD countries, OECD markets. That's not on the agenda today, to use that 20% allocation. However, some of our customers, like Tesco's, for example, have a footprint in some of those countries. And of course, if they ask us to evaluate those markets, we certainly will, particularly if it's a customer that we know well and that we can offer them a full solution over. So to answer your question, Republic of Ireland for sure, but in terms of those other countries in the OECD regions, we would certainly contemplate it if it's one of our existing customers here in the UK that's driven that demand. But not on the agenda to kind of build new sites out there just yet.
Yeah, cool. Okay.
I think the demand in the UK and Ireland is so strong that actually there isn't much need. So yeah, we're in a good place here in the UK.
Cool. So you mentioned the dividend there, and you mentioned it earlier as well. So that's been put up for this year, isn't it?
Correct. Yeah. So the dividend was increased from 5p to 5.5p for this financial year, and so that's a healthy uptick. And then, as per the results, the dividend cover of 1.4 times over and above that new dividend does give us confidence about growth going forward.
No, that's really interesting. Cool. I think this question refers to a slide earlier, so let me try and find it. About the 20 billion, 23 billion investment. So do you have any examples of transactions within the fund that reflect this 20 billion investment requirement?
I guess all of the investments, that we've done to date is in the UK, and so all of those investments, I guess, make up, part of that the requirement to get to 23 billion. This figure here is essentially, working out what capital is required to get from 16 gigawatts of capacity to 54 gigawatts of capacity, over the next 10 years or so. And that's the CapEx requirement to achieve that.
Yeah, cool. So, I mean, like you've said in your presentation and throughout this, and we've had guests on from other sort of renewable energy. So, why do you think there is such a wide discount in that sector of the investment trust sector, given obviously the need for this kind of stuff?
Look, it's important that firstly, what I say isn't perceived as advice of any sort, right? So this is just my view, but clearly, there is a correlation to the share price of the sector in general with the movements in the risk-free rate, in the government bond yield, and that can't be denied, right? The correlation is too strong, and I think it's fair to say in the last couple of years, well, probably the last year, I should say, we have seen an increase in the risk-free rate. We have seen the increase in government bond yields, and that has affected the appetite and demand for investment trusts in general, not just in the renewable space. And so I think that that is probably the biggest factor.
Yeah,
I'd say that's the biggest factor in this kind of environment.
So do you think, I don't want to do any sort of future gazing or anything here, but what do you think will spark a turnaround in investor sentiment then? Do you think when interest rates start to sort of come down, or what's your thoughts?
Yeah, look, and this is probably true for all equities, not just investment trusts. Clearly, it is a cyclical dynamic, right? Things don't stay the same forever. One clear data point here is inflation levels, and that seems to be dictating sentiment over the risk-free rate.
Yeah, no, cool. Okay, well, I think we've got through all the questions there. So yeah, thank you for coming on. Very informative and enlightening as always. So yeah, all the best. Cool. So that just leaves me to wrap up and tell you who we got on next week. So Charles Gillings from Utilico Emerging Markets will be on, and Andrew McHattie will be on for his sort of monthly roundup of February. Should be interesting. You can see there we've got sort of full roster of guests coming on. Interestingly though, at the end of March, 22nd of March, we're doing our first quarterly panel, which will be like this show, but we'll have a panel of 3 guests discussing sort of trend each quarter. This time it's going to be on Has the Tide Turned? So if you go onto our website, you get details of that panel and who's on it, and the discussion themes and things like that. We'll break for Easter and then we'll be back with Life Science Read. So yeah, thanks a lot for tuning in, and see you soon.